All right. Welcome everybody to Finance 333, specifically week 3. And good news of week 3 means that you're halfway through the course. Hopefully you feel caught up and at a point now where you are actually at halfway. And grading for week 2, we'll get that done between tonight, tomorrow morning, and maybe even into the day tomorrow. We're a little bit later today as far as my grading, just because I went up to Idaho to see the total eclipse, the totality of the solar eclipse today at 11:33 this morning, which was phenomenal. Great experience, really neat. Encourage others to, as everybody's doing on Facebook today, encourage others to get that opportunity if they didn't this time, next time, if they have the chance. So anyway, a little behind on my grading though, which just means that it might be pushed out a little bit, might not be as early as it was last week. I think I had it all done by Monday night last week. This week probably push into tomorrow if I were to guess. But anything that's turned in on time will be graded soon, so that you have some feedback halfway through the course and how you're doing. Last week looks like it was a pretty good week as far as participation, but like I say, I don't have any feedback yet on the grading. I have gotten some questions throughout the week on the assignment, on the assessment, and also on the week 1 grading and work that's turning in late. Couple quick notes. First of all, as we mentioned in week 1, you are more than welcome to turn things in late. You don't even need to touch base with me. I don't mind if you do, but you don't have to. You can turn things in late. I don't give full credit, and it really doesn't matter the reasoning or excuse or situation unless you've got some kind of letter from the advisor, your advisor through the school. And I know that sounds kind of harsh, but we're not in a classroom setting. I can't see you. I don't know you. Everybody's got reasons, and challenges, and so I can't give everybody an exception to the late work rule, or it just spins out of control. So if you need an exception, a legitimate exception, go ahead and speak with the school and get an advisor note that they send to me from a doctor or something like that, so I can give you an exception. Independent of that, you're not going to lose enough credit to be overly concerned about it. You will lose some of the points, obviously, by not being on time, but you'll be able to make those up on checkpoints. If you're diligent on checkpoints, you'll be able to make those up on other things throughout the mod. So don't get stressed out if you're a day or two late. Get it in as soon as possible, get caught up, and then try to stay caught up in future weeks so that we don't lose more points, right? It's reasonable to think that maybe 1 week out of a month you might have something come up where it really is just difficult to get things in on time. It's not very reasonable to have it happen every week. It usually means that we're waiting too long, in the week to start, and then things get in the way as the week progresses. So just get an early start if you find yourself having a challenge, being challenged to get things in on time every weekend. All right, enough about that. I mentioned to one of the students this last week that I would spend just a couple minutes on showing you the math from the week 2 assignment. Like on the case study, the very last question asks a situation where you've got this $100,000. You're going to put it into a fund. The fund pays 10%. You're going to try to take $1,000 or $1,500 a month, and then you're going to redo the calculation using a 15% assumption, and just give some feedback on those numbers and the situation. So hopefully that went okay for most of you. There are financial calculators online that you can look up, and not have a problem with. But I did want to show you how you could do it within Excel, because I think this is a helpful, quick exercise. After we get done with that, we will start discussing chapters 13 and 14 for this week. 13 is about managing your own portfolio and building your own investment portfolio for investments, which you could do within an IRA or 401k or any kind of investment account that you have. And then the second chapter that we'll cover tonight talks about options. And if you've ever been up late at night watching late night TV, sometimes you'll get these infomercials about how you can make money if the market goes up or if it goes down, right? So you can make money in either situation. A lot of those commercials, there are other products as well, but a lot of them are focused on options. And it's true that if you are an option investor, there's the potential to make money both in good times for the market and in bad times for the stock market. So the idea is correct, but the ease and the pitch is that you'll always make money with their system. Well, of course, there's the devil's in the details, right? It's a little more difficult and a little more high risk than what they lead on in an infomercial, as you should expect, right? Because they're trying to sell you something. But we'll talk about options, what they are, how they work a little bit. We're not going to be able to dig too deep. Your assignment for this week is about options, so that'll come from chapter 14. You'll want to review the section on options in the book so that you can do the problems and calculate some pretty straightforward examples of options and how to use them within the assignment. Short answer questions within the assignment. This week's assignment is less about a volume of writing and more about just answering, quick questions and math problems. This week's assessment is a little bit shorter. I mentioned last week was kind of midterm of sorts, and so it was a little more comprehensive, a little bit longer. This week is shorter, back to 10 questions, all multiple choice or true false, and so should be welcomed, right? Shorter test. And like always, once we go through chapters 13 and 14, we'll leave approximately 5 minutes at the end to just go over the topics that will be on the test for this week so that you have those topics and can be more purposeful in your study this week as you prepare. All right, before we get started with all that, all the stuff I mentioned that we're going to cover tonight, any questions, concerns for the two of you who are here tonight? What can I help you with before we get started? Anything that would be helpful? Okay. If you think of anything, just let me know. You guys are making the sacrifice to be here during the live session, so I'd be happy to give you some help if I can, specifically to you two. If there's anything that I can do for you, let me know. As well as anything, that any questions or concerns that come up as we discuss, anything that you'd like to know that you're curious about, I'd be happy to share and stop wherever we're at to give you some time. So, all right. So the 12-2 problem from last week, part D asked if the mutual fund earns 10% annually and we want to get $1,000 a month or $1,500 a month, what would be the size of the investment after 15 years? And then what about if it got 15%? Okay, everything else about the situation stayed the same, but it got 15%. So how do you do that calculation on D? So one of the ways that you could do it, as I mentioned, there's different calculators online that you can use, financial calculators. You could have your own financial calculator. But one of the ways you can do it is you can go into Excel. I know all of you have Excel, or at least should have Excel. You can go under formulas at the top of the page, then under financial formulas, and then you've got all these different preset, pre-formatted financial calculators that are here. FV stands for future value. This is a future value problem that they're wanting you to solve for, because what they're telling you is you've got 100,000 now, you're going to get 10% return, you're going to pull $1,000 a month or $1,500 a month. We need to calculate for both, and they want you to tell us what is the number, what is the value of the investment after 5 years. Okay, so the value of the investment after 5 years is a future value problem, or FV, within Excel. Okay, now can you two see this pop-up box, this function arguments box that just popped up within Excel? When I go under formulas and then financial formulas, it should pop up another box, that shows these other boxes, right? So it shows our rate, number of periods, which is that second box, payment, which is the third box, present value, which is the fourth box, and then type, which is something that you hardly ever have to use. Okay, I'll just tell you that now. We're not going to use it for this one. So it's told you that the rate is 10%. However, it's telling you that you're going to get a monthly payment. And if you're going to get a monthly payment, we have to convert everything into months so everything's consistent. You can't do years under the rate and then do months for the payments, right? So we have to convert the rate to months. Well, if you take a 10% rate, divide it by 12, what you'll get is 0.8% or 0.008 as a percentage. That's the decimal form of 0.8%, okay? So 0.008 is the rate. Number of periods, 5 years, but we got to convert it into months. So 5 years equals how many months? It equals 60 months, okay? Your payment, this is a payment that's coming to you, so it's a positive number of $1,000 a month, okay? And present value is a negative number because this is the amount of money that you had to put into it, okay? So you had to put $100,000 in, and if you put $100,000 in, which is a negative number, right, because you put it in, did I have enough zeros there? Nope, one more zero. And so you put $100,000 in, it's written as a negative number because that was outflow, right, money that came out of your pocket. Payments are a positive number because they're inflows. $1,000 a month, 60 periods, which is 5 years, 5 times 12 equals 60, and then 0.008 is what is 0.8%. Okay, that's the decimal form of 0.8%. Now, it's already solved my answer for me right here. $84,675 is the amount of money that I'd have after 5 years if I'm getting $1,000 a month. And if you think about it, that makes sense because you're taking $12,000 out of the account, you're getting a 10% return on $100,000, which is only $10,000 a year. So your value of your account has to go down, right? Because you're taking $12,000 out and you're only gaining $10,000 that first year. And each year after that, you're going to be taking money out, but you don't have as much as you had the year before. So it's got to go down over that 5-year period of time. Okay. All right. So that's how you would calculate that problem using Excel. Now the second problem is you just change the payment to $1,500, right? And do the same thing. All you do is change the payment from $1,000 to $1,500. Then you change the rate, right? Because it asks you to calculate it based on going from 10% to 15%. So instead of putting in 0.008, which is 10 divided by 12, you're going to put in 15 divided by 12, which is 1.25, if I'm not mistaken. So 1.25% or 0.0125. Okay, that is 1.25% in decimal form. Okay, so you change the rate, change the payments around a little bit, don't change anything else about the equation, and then it'll give you the answers that it's looking for. You should have had 4 separate answers for that problem last week. 12.5, if I'm not mistaken, the last one under the section and case study. Now, if you're looking at this as we go through it and saying, oh, I did it totally wrong, my numbers don't even look like that, just make a mental note that you can go back to this kind of tutorial that we just did or explanation of how to do it. You can resubmit the assignment after you get some feedback on it, or you can resubmit it even before I grade it if you'd like, and I'll give you more points if you've gone in and done it. Okay. Again, that last problem would have had 4 different answers. One for $1,000 a month, one for $1,500 a month at 10%, and one for $1,000 a month and $1,500 at 15%. Okay, so there were 4 different scenarios that it needed you to calculate. And then it needed you to give a little bit of feedback on why, why is that the case, right? So hopefully you were able to do that. Hopefully you all did just fine on this. Deja, Victor, did either of you have any questions on that or any problems, or were both of you able to do it okay? Or are both of you planning on resubmitting and redoing it now that you've had a little bit of feedback on how to do it? Or are both of you looking at Facebook on all the people posting about the eclipse? Hello, Bueller. No worries. Hi, Brad. Thanks for coming. Okay, does anybody have any questions? Okay, so you're able to maybe do it, redo it if you need to. Brad, I just went through a little tutorial on how to do the math, that last problem for last week's assignment. And so I was just asking, does anybody have any questions, or did that help? Will you redo it, or did you do it fine? I was just looking for some feedback. Sounds like we're okay. We might have some resubmissions on that, but yeah, Excel is easy to use if you know exactly how to use it. It's not very straightforward if you don't know how to plug in the numbers, right? But if you go to formulas, financial formulas, go to FV, which is future value, and then type in the right inputs, right? If we put in the wrong inputs, it's not going to give us the right answer. But if we type in the right inputs, we'll get all 4 answers, and that's what you needed for 12.5 last week, okay? All right, that's all we wanted to do there. Let me get out of this. We don't need Excel anymore. Oh, I did want to show you real quick, and we might as well do it at this juncture, the assignment for this week. So this week is another case study. As I mentioned early on in the class tonight, the case study for this week is about options. We're going to spend a little bit of time talking about the basics of options tonight. We're not going to go into the math very much, so if you need additional help, either get with me or get with the learning instructor or learning coach earlier on in this week, the better. But really it comes straight out of chapter 14, so if you'll just carefully read the chapter, look at the example problems, you'll be able to change the example problems to these problems, that you're looking at right here on this page, if you've checked those example problems, and be able to figure out the values just fine. It's not hard math. It's not going to take a financial calculator this week. It's just going to be simple math, timesing, multiplication, subtraction, addition, and division. So nothing too complicated. It's not time value of money type stuff, but it is. You do need to plug things in the right place, and so looking at the example problems in chapter 14 is the way to do that. Okay. So that's the assignment for this week. I did also mention that it's not as much about writing this time. It's more about just getting the answer, right? Kind of solving for the answer. There's a little bit of feedback, some feedback questions, like question A when it says, what would be the major drawback? Obviously, we want some feedback to that. Or should Luke use the puts as a hedge on part D? We'd want some feedback on that. Not just yes or no, but why, right? Why should he use it or why should he not use it? So moral of the story is I would always read the chapter, right? The assigned reading, but this week, especially for purposes of the assignment, make sure that you're carefully reviewing chapter 14 and carefully looking at the example problems so that you'll feel comfortable once you get to the assignment. Okay? All right, so that's this week's assignment. Let's go back to managing your own portfolio. Now, before we begin with 13 and 14, chapters 13 and 14, 13 on managing your portfolio, 14 on options, any questions, knowing that here in a little bit with the last 5 minutes of class, we always go over the test material, right? We'll have 10 multiple choice questions that we'll need to review briefly the topics on. But before we get to slides from chapters 13 and 14, any other questions, concerns, problems at this point? All right. So why is it important that we understand the basics of how to manage your own portfolio? You might say, well, I'm just going to hire somebody else. I'm going to get an advisor. I'm going to have my friend help me, whatever it is. The important part of this is not a question of whether or not you should do it on your own or not. The important part here is whether or not it makes sense, whether or not you employ someone else as an advisor or whether or not you do it on your own, that you understand some basics of asset allocation investment planning. And if you understand some basics, you'll be able to avoid pitfalls that either you yourself or an advisor sometimes might put you in as far as your investments. You could compare it to me going to a dealership versus buying a car online, right? So a dealership, a salesperson, I'm going to have a salesperson to walk me through every step of the process. They're going to explain everything, pros and cons of the car, point out all the benefits, everything like that. If I buy it online, I'm not going to have a person to do all that, right? But I might save some money. So same thing is true for investing. If I do it on my own, I might save some money. If I go through an advisor, I might get, it might be an easier process. I might get more of an explanation. However, in both cases, it would be foolish to go in without having done some homework before you go in, right? So just as an example, if I'm looking for a sedan and I show up at a Ford dealership, they're going to show me the Ford Fusion, right? They're not going to show me other cars. They're a Ford dealership. That's what they're going to show me. So if I haven't done my research and I don't know that I already want a Fusion, that's a poor decision to just show up on a dealership lot. Okay. I should do some pre-work right before I get there. Do some studies, look at some results, look at feedback on these different cars, know basically what I want before I get to that car lot, right? And then I can appreciate the help. A salesperson might give me a lot of insight and perspective and additional help with what it is, with my decision making. But it's important that I already did some pre-work. Now, if I do it on my own, right, if I buy it online, I really need to have done all my work, right, to make sure I get the right thing. I know what to look for. I know what price I should be paying, all those types of things. But either case, in either situation, whether or not I buy online or whether or not I buy from a dealership and talk to a salesperson, I need to have done a base level and have a base level completed of just understanding a little bit about what it is that I prefer, what it is that I want, what kinds of things get good feedback, and where the pricing should be before I ever step onto a dealership lot. Okay, that's just my personal opinion. And the reason I bring it up is because the same is true for investing. If you're going to manage your own portfolio and do it online, you obviously you need to have done your homework and figured out what it is that you should be doing with your investments. If you're going to work with an advisor, though, sometimes it's even just as important that you have done your homework, because many advisors are looking out for their best interest and not for yours. And that's an unfortunate statement, right? We'd hope that every investment advisor is looking for your best interest, but it's just not how it works. There's a lot of folks out there that might mean well, but in the end, they get in the crosswires of trying to provide for themselves and make money and sell you products and put you into different things, as you can imagine. And in doing so, sometimes they're not always looking out for your best interest unless you help them to do so by having done some of your own homework. Okay? All right, that's a long way of saying I think it's very important, okay, that we have this view that we need to have a base level of understanding. Just, you don't have to go deep, but you need to know the basics of managing your own portfolio. And first and foremost, it comes down to making sure you have a good asset allocation and good diversification. So if you're working with an advisor or managing your own money, either way, and you're not diversified, you don't have a good asset allocation, there's something wrong. We need to take a good look at it. We need to make sure that you're diversified, make sure that you don't have all your eggs in one basket, because that's not ever prudent, right? It's not that you can't have really good times when things go well for that company, but then at some point, it could turn into a Enron or a WorldCom or a situation where you've just got too many eggs in one basket, and at some point it blows up on you. Okay. So we want to make sure we have good asset allocation, good risk for the reward that we're taking, not too much risk for the amount of reward that we're looking for. So there's always a risk-reward trade-off that we talk about when it comes to investing. We want it to be well allocated and well diversified. And you can do that on your own. That's not impossible to do on your own. It might sound a little bit intimidating if you haven't done investing before, but there are a lot of great tools online to help you do it. So first of all, you need to understand yourself. You need to be self-aware. So before you can make good decisions about investing and even have a diversified portfolio or good asset allocation, you need to understand how much risk is prudent for you to take. And the only way to know that is to understand yourself, right? The first thing you need to understand is kind of your own financials, right? What is your net worth? What is your income? How stable is your income? How old are you? That's a really critical factor, right? As you age, you probably should look at considering things that are more focused on income or more conservative, potentially. When you're younger, you potentially should look at things that are a little bit more aggressive for growth long term, right? It's just a different, if I'm 75 and in retirement and trying to get income for my retirement because I'm no longer working, I have a very different asset allocation and investment portfolio, most likely, than the person next door that's 25 years old and just getting started and wants to save for the next 40 years for retirement, right? They're not focused on income. They're not focused on being conservative. They're focused on just trying to grow their money the best they can. Okay, and this should be pretty straightforward, pretty easy. The differences or the nuances that happen are between one person with another that happen to be the same age but have different preferences, right? And different income and different net worth and a completely different situation. And then you got to dig down a little bit, understand yourself well enough to know what types of investments are right for your situation. Okay, because something that's right for somebody else doesn't mean anything as far as you're concerned. You need to make sure that the thing that you look at is right for you. That would be like saying the next door neighbor bought a Suburban, so we should buy a Suburban. Well, if you only have one person in your household, it's just you, maybe a Suburban's not the most cost-effective thing to have. Might be, right? Might be the best thing ever, but it might also not be, right? You might be better off with a two-door, a compact sedan that gets great gas mileage, right? Because you don't need a big car. So anyway, there's just different things that are suitable for you, and it just depends on your situation. You got to be aware of your situation, tax considerations, investment experience. There's all kinds of different things. But once again, age is a big factor, when it comes to how you should invest. And then as far as objectives are concerned, okay, so now that we know our situation, we're self-aware with the types of, our circumstances. The next step is to consider what types of objectives we have from our investments. Are we trying to grow them long term? Or are we trying to get current income, or is there some mixture of both? Okay, and it could be a mixture of both. I have clients that come in all the time and say, I would like a little bit of income. I say, is that priority one? And they say, actually, no. Priority one is preservation, right? So their first objective is to preserve what they have. Their second objective is to get some income. So if preservation is their first strategy, we need to be very conservative, right? If growth was their first priority and preservation's a distant second or third, then maybe we can be more aggressive. But we need to understand for ourselves, what is our priority? What is our time frame? What is our personality for investing? What is my financial situation? And it's not hard. Just as we're talking tonight, the three of you who are participating tonight could all probably in your heads, while I've been talking, come up with basically what your suitability is for you. Because you can immediately answer all these questions in most cases. Every once in a while, you have to think about kind of what you're comfortable with as far as risk, but things like age, family issues, income, net worth, investment experience. Those are all things that are, just really straightforward question and answer, and get you to a point where you can kind of understand better what you should be doing. Okay. And then whether or not you're focused on current income or capital appreciation should just be a really easy, yeah, I'm young, I want to invest for the long term, or, I need income right now for my investments, so I'm a current income investor. So anyway, pretty straightforward, pretty easy, doesn't take a lot of time and effort, but very, very important to go through this exercise before you ever put a dime anywhere. Because the folks who just throw money at the wind, right, and just throw money at whatever investment opportunity sounds good, they end up with things that they shouldn't have, that aren't suitable. And then when things get tough at some point, which a lot of investments, have cycles, right? And they can get tough at some point because it wasn't suitable in the first place and they didn't get the thing that was right for them. They're very quick to then unload it, and sometimes unload it at a loss, which is a horrible way to invest. Back to our car situation. If I went to the Ford dealership and I hadn't done any research on sedans and I asked them for a sedan and they gave me a Fusion, right? And then I get it home and I drive it for 6 months and I decide I don't like how it drives, I don't like how it feels, I don't like some of the functionality, I don't like the gas mileage, I don't like how it looks, I don't like how it's been in disrepair a few different times. All these things happen, and then I look online and I find that everybody else's feedback is consistent with mine. And if I would have done my research beforehand, I would have known that. What do you think I do at that point? Well, either I'm really dissatisfied, right, with my choice, or I go sell it. Well, what happens if I go sell it 6 months after I bought a brand new car? I take a loss, right? I take a big loss. It was a huge waste for me to have done it that way. And the same thing is true for investments. When we don't do our research, when we don't look into it, when we don't have a basic understanding of what we have, and then it gets tough for a little while, which investments get tough, almost every type of investment gets tough at some point. If it gets tough and we haven't done our research and we're not, we don't have conviction behind what we have, we'll bail on it. Just like we're going to bail on that Fusion because it wasn't the right choice, right? We just made it kind of at a whim. We made a gut choice, right? An impulse buy, as we'd call it. And the same thing is true for investing. When we make impulse buys and investments and we don't have high conviction, when it gets tough, we get out. And by default, if it's gotten tough, that means we've lost money and we got out at the wrong time. Most times, time and patience will cure, right? Because everything cycles. And so if you'll just wait long enough in any kind of investment, you'll be fine. If you have high conviction, you will wait. If you have low conviction and didn't do any research, you won't wait. You'll take a loss and it'll be a horrible experience. Okay? Kind of basics, emotions 101 or investing 101 there for you. Okay, so we've got these different objectives: current income, capital preservation, capital growth, tax efficient objectives. You might have a situation where you're just at a very high tax bracket, and so you've got to overlay everything you do with taxes in mind. A lot of people, think that taxes are their priority, but as I dig into their situation, taxes really aren't as substantial of a problem for them as they think they are, right? None of us want to pay more tax than we are or have to, but most of us are in a situation, if we're in the middle class, where we're not actually paying a net effective rate that's very high when it comes to taxation. And so these other objectives are probably higher on our list. We can always think about taxes, but we'd put growth before just doing something that was tax efficient only. Okay. People get derailed by that, though. They end up buying annuities or life insurance just because of the tax consequences, just because they're tax efficient, when in reality, they should be much more focused on, things that, that really are more efficient about growing their money and less worried about the tax situation. They get derailed by that and end up in very inefficient investments because they're so focused on the tax side. Okay. So just keep that in mind. Make sure that your objectives really fit who it is that you are, and not just what people on the radio or people within advertising say you should be focused on. All right, so what is asset allocation? We've referred to it a couple different times, but it's the process of dividing an investment portfolio among different investments, okay? That mixture that we're trying to get to, that asset allocation that we're trying to get to, which is the mixture of investments that we have, is going to maximize the amount of return that we get for the amount of risk that we're willing to take. So basically what computer programs do with asset allocation is they say, okay, how much risk is this person willing to take? Are they willing to take moderate risk, conservative risk, aggressive risk, balanced risk? Where are they on a scale of 1 to 10 as far as how much risk they're willing to take? And then it spits out, based on 20, 30, 40 years of history on different investments and the combinations of those different investments, a diversified portfolio that will give them the most return for the amount of risk that they were willing to take. Okay. The thing that a lot of people do when it comes to investing is they go backwards. What they do is they look at different investments as far as the returns that they got, and then they make their decision based on the returns and not on the risk. Why is this dangerous? Because you could be investing in something that has a lot more risk than you should be taking. And again, if you get into something that has more risk than you should be taking, and then it goes down, what's the first thing that you do? You panic and you sell because you don't have high conviction about what it is that you have. Where if you went through a process of having a highly diversified, good asset allocation portfolio based on the amount of risk that you're willing to take, and know that at least according to history, you're maximizing the amount of return for the risk that you take, then when the risk starts to make your account go up and down, or the cycle goes against you, or it starts to fluctuate, you'll be able to say, okay, but this has 30, 40 years on my side. As long as I keep consistent with my strategy, I'm going to end up, maybe not today, but I'm going to end up getting the best return I can for the risk I'm willing to take. Okay? So asset allocation is critically important. If you go onto Fidelity or E-Trade or Ameritrade and you just buy a couple stocks and think, okay, I'm diversified, I've got a good asset allocation, that's not a good asset allocation. That's not a highly efficient asset allocation. We want a highly efficient asset allocation. The only way to get that is to make sure that we've got good complementary investments that'll help each other. When one cycle's bad, the other will cycle good, and overall your risk will be what you actually are choosing to have, and not just some black box where you don't really know how much risk you have with the investments that you have. Now, does this mean that you have to have an advisor to do this for you? The answer is no. There are a lot of programs online within Fidelity, E-Trade, Ameritrade. All of them have planning sections or investment allocation sections that help you build an asset allocation. You do not need an advisor to do this. You can do it on your own if you want to, and it doesn't require an advisor to have a good asset allocation that maximizes, again, your return for the risk that you're taking. Now, something that's critically important on this particular slide is at the end here. It says as much as 90% or more of a portfolio's result comes from asset allocation between various classes. So most of what you get from investments isn't about timing, isn't about being right on the timing or right on the specific product. It's usually, and some people measure this as much as 95% of the return has to do with your allocation, what you're allocated to. So sometimes you can just be ignorant and right? So if the last 5 years I allocated to the S&P 500, which is the 500 largest stocks in the United States, I would have done very, very well. I would have done very well because that happens to be the category that did the best over the last 5 years. But over the next 10 years, it's unlikely that it will be the best category, right? Because each one of these categories cycles, as we've talked about, up and down. So if something's been the big winner the last 5 or 10 years, it's unlikely that that same category will be the biggest winner the next 5 or 10 years. And it's better to have an allocation, right, that's highly diversified. So just in case the S&P is not the big winner the next 5 years, you're still going to be okay. Okay? That's what the asset allocation is all about. Diversifying and maximizing return for the amount of risk that you're taking. So there's a couple different ways that you can approach asset allocation. You can have fixed weighting, so I can have 10% that's always going to be in cash, and I can have 50% that's always going to be in stock, and I have 40% that's always going to be in bonds, okay? And it's just fixed, and I will never vary from that allocation. That's one approach to asset allocation. Another is flexible weightings, where you have kind of a sliding scale up or down based on what you think the market's doing. And then another is a tactical approach where you really try to go and change things based on what you think the market's going to do. But it's much more, there's much more movement going on with your asset allocation. Most people, when they invest, for example, through an advisor or through Fidelity or E-Trade or Ameritrade or Vanguard, they're using the fixed weightings approach, or even within their 401k. What they'll do is they'll set weightings to different categories, like 50% to large cap, like I mentioned, and they don't vary from that because they don't, the more they seem to tinker, the worse their returns get. So they just try to stay consistent with a fixed weightings approach. If you're paying somebody to help you with your investments, they might have more of a flexible weightings or tactical approach because they're looking at it all the time and trying trying to get a little bit better returns by making movement, in a certain direction instead of just keeping everything fixed. But both can be highly effective. You don't need to do one over the other. One's not superior to the other. Just different preferences on how to do asset allocation. Okay. All right, so here's just some example weightings of asset allocation. So if you're really conservative, you have most of your money in bonds and short-term securities there on the left. On the right, you'll see that if you're really aggressive, you're going to have most of your investments in, the majority of your investments between common stock and foreign securities, the combination of those two, which is more aggressive, right? Has higher potential for return. Most advisors and programs online agree generally how much should be different in different categories. And I say generally because they're usually 5 to 10 to 15% common, meaning they're have a common allocation percentage to the category that you're looking at. But most all of them have a little bit different amount in the end. So generally they're the same. But when you dig down to the specifics, one might have a little bit more in large cap, or a little bit more international, or a little bit more in bonds, because that comes down to the preference of the firm that you're working with and what they feel like is best. Okay. All right. Asset allocations. So how do you evaluate returns? Okay. How do you evaluate returns? So first of all, you're going to gather your own investment returns. You're going to look at your 401k statement, or you're going to look at your statement, online, or whatever it is that you have that gives you record of how you've done with your investments. Then you're going to actually benchmark, what we call benchmark, versus the market, okay, and see how the market is doing, like the S&P 500 or the NASDAQ, which is another index that you can compare to. Very easy to find. It's very easy to find the NASDAQ's return, or the S&P 500, or the Dow Jones. They're very easy. Yahoo Finance, Google, any of these indexes, and they'll give you the chart, right? Give you exactly how they've done. Then you can go into them and actually compare certain time periods and make sure that your account's doing okay. Now, then you compare your performance and your investment goals. And are you doing better or worse than the market that you're comparing it to? Do I have a problem investment? Am I getting a proper return? Am I taking less risk in the stock market? If I am, I should get less return, right? That's natural. That's normal. If I'm taking more risk in the market, I should get better than market returns. And if I'm not, then something's wrong, right? And then you determine, what you should do next. Should you sell something? Should you keep it? Should you monitor something a little bit more closely? This is how professional managers do it. It's not more complicated than this. They're just always, on an ongoing basis, looking at how they're doing versus what the market's doing. And if they're taking more risk in the market, then they're looking at ways that they can up, their returns and maybe make changes to do better. Okay, if they're taking less risk in the market, they know exactly where they should be relative to the market, and they're evaluating that. Okay. All right, any questions on how to evaluate your own investments? Anybody want to take a stab or a guess at how often you think the average person with their 401k that is invested, how often do you think they would do this evaluation process? How often do you think the average person evaluates, using this process we just talked about, how often do you think they evaluate their investments? Yes and yes. You guys are both right. They might evaluate it once and then forget about it, Deja, and most people, Brad, don't ever do it. And they should at least do it once a year, okay? At least once a year. They shouldn't do it every day, right? That'll make them crazy. But it wouldn't hurt to do it every 3 or 6 months, but at least every year, okay? Make sure and evaluate how you're doing. Now, this evaluation process has one big hiccup that happens with most people if they are evaluating once a year in their 401k like they should. And that is that a lot of people's evaluation process doesn't follow what we just talked about. A lot of people's evaluation process is just look at the funds that did the best over the last 5 years or 1 year and buy more of that, whatever it is, the big winner, right? Now, based on every single investment and we've talked about this, every single investment is cyclical. How successful do you think it is if every single investment has cycles to pick the one fund within your 401k that's on top? Does that make sense? So I'm going through my 401k, I'm going through the different investment options, and I'm saying, okay, this one did the best. Out of all the different investments, this one's done the best this last year, so I'm going to invest in that particular investment. How effective do you think that type of investing is? It's not a trick question. It should sound wrong. Okay, what I just said should sound wrong. It's amazing how common it is, though, that people will just look at whatever's done best and invest in it. And here's the pitfall, or here's the problem. Logically, we know if something's doing really well, we already missed out on those returns, right? That happened in the past. Doesn't guarantee the future. We know that. What we don't usually put together is the fact that every single investment category, like I just mentioned, has times where it's ahead, and every single category has times where it's behind. Okay? So if all we do is go in and try to chase whatever category happens to be the winner, it's already been the winner. It's unlikely to stay the winner because everything cycles, and it can be a very poor way of investing. Basically, we're just chasing the most expensive categories. If you look at it as I'm chasing the thing that's most expensive because it's already done the best, then maybe it'll change your mindset on what you should invest in. Maybe you should chase after the ones that have done a little bit more poorly for a time. Okay? Within the context of making sure that you have a good asset allocation. Okay? The answer to that, Brad, is yes. In exchange traded funds, you do get dividends. In fact, for the ETF to be qualified, meaning they don't have to pay taxes on the income, they have to distribute it just like mutual funds do. So similar rule for them as you have in mutual funds. Good question. Okay, so maybe one more slide on, building portfolios or managing portfolios yourself. This is the HPR, or holding period return. If you're looking at your investments and you don't have a way of calculating how well you've done, well, first of all, you should any platform that you use, whether it's, as I mentioned, Fidelity, Vanguard, Principal, any one of the providers that I know of out there should be giving you holding period returns every single month in either electronically or by a paper statement. And then anytime you want, you should be able to go in on their online system and be able to calculate very easily any period of time how you've done. Okay, so if I want to know since the beginning of the year or year to date how I've done, it's going to automatically calculate my holding period return for me and tell me year to date you've done 7% in your portfolio. Okay, why do we even care about that? Because that's how we evaluate how we're doing relative to the market, right? We need to know our holding period return so that we can evaluate it like that prior slide just mentioned. We need to be able to evaluate our investments, and we need to have a benchmark, and we need to know how well we did in order to evaluate. So if it doesn't tell me those things, which again, most platforms will tell you this stuff. If it doesn't, this is how you would calculate it. You take your current income that you got during that period. So let's say you got a couple $100 worth of interest or dividends. You would add that to the capital gain or loss for the period. So let's say your account went from $1,000 to $1,200. Okay, so you had a $200 gain, plus I mentioned that you had, I think I mentioned $200 worth of income. So that's $400 worth of total return. Okay, you add the income plus the capital gain. That gives you the total return. Then you divide it by the beginning investment value, and that gives you your percentage return for that period. So in the particular case I just gave you, that's a 40% return for that period. You got $200 from dividends, and you got $200 from capital gains, and you only started with $1,000. So what total benefit did you end with? You ended with $1,400, or a 40% return. Okay, so that's an example of how you'd plug those numbers in. But basically, you're just adding the income plus the capital gain or loss and dividing by the original value, and that gives you the return percentage for that period. Okay, so you can calculate it anytime you want, as long as you know the numbers I just mentioned in order to plug them in. Maybe you're not getting income. Well, you just take that part of it out. What if you get a negative return? What if it goes from $1,000 down to $800? Well, the number you plug in for your capital gain or loss then is negative $200. And it's likely then at that point that you'll end up with some kind of negative return for the period, right? Unless you've got just substantial income. Okay, so that's how you calculate your own returns. Anymore, most of us are pretty lazy about this because, as I mentioned, most platforms will give us this information on demand. I can go into my accounts, I can calculate for any period of time I want, exactly what the return was. So there's not really much reason for me to go in and manually, calculate my returns now that I can do this very easily online. Okay? All right, here's an example where somebody got a 24.6% return. That's a great return, right, over a 1-year period of time. You had income plus capital appreciation over the original amount of investment. That's how you get to that answer. Okay, that's about all we want to cover from this particular set of slides from Chapter 13. Any questions on building your own portfolio, asset allocation, and investing on your own before we get to options? Okay. Let me pull this up then. All right, so this is Chapter 14. As I mentioned earlier, Chapter 14 is where your assignment comes from. So if you're going to spend some extra time on something this week, I would study Chapter 14. I would read it early in the week, try to digest as much as you possibly can, look at those example problems like we mentioned. Then I would look at the assignment, kind of get a feel for what you're going to need to know for the assignments, just some basic, straightforward option strategy questions and calculations, and then go back to Chapter 14 if this were me, and actually read it again looking for exactly what you need to know for that assignment, okay? And then being able to apply the examples to your actual assignment. All right, so let's back up though a little bit. And what is an option? I mentioned to you before that if you're watching late night television at 2 or 3 in the morning, you will see people pitching options. They might not call them options, but their investment strategy is called options. And what they are is they're a derivative product. And what that means is they derive their value from other products, okay? The definition of a derivative is something that derives its value, gets its value from another product. So when we talk about an option strategy, or when we talk about buying options, we're buying a derivative financial product that's based on the value or movement of an underlying product. So if I buy a derivative option on the S&P 500, or SPY, which is the S&P 500 index, that means that the value of the S&P 500 index going up or down is going to change the value of my derivative. So I derive the value on my derivative based on what happens with the underlying product. Why wouldn't I buy the underlying product? Well, there's a lot of answers to that question. Usually people buy derivatives because they can use leverage, which means that they can use somebody else's money to do it. And they can also get potentially good returns whether or not the value of that underlying asset goes up or down. So let me give you an example of something that might come up. You might say, okay, I don't like the stock market. I think the stock market's overvalued, and I think the stock market's going to go down. I have people tell me that sometimes. I don't want to invest. I think the stock market's going to go down. And I would say, okay, Mr. or Mrs. Johnson, you think the market's going to go down. Would you like to invest in a way that would have you benefit if the market goes down? And sometimes people say, oh no, even though I think it might go down, I'm not willing to bet on it, right? I'm not willing to invest in it. And that's okay. But if they say yes, there are ways for us to either buy options or short the market and basically benefit if the market goes down, okay? Now, what happens if the market goes up when we make the bet that the market's going to go down? Well, just what you would expect. You lose money, right? If you're wrong about which direction you're picking, you would lose money on that particular option trade. So as a CFP, am I able to trade options without conflict of interest or nature of my position? The answer to that is twofold. I can trade options personally. I'm highly regulated, which means that my firm gets to watch everything I buy and sell. I don't get to do anything privately, even though I do it within my own account. They get to watch and they get record of what I do. If they felt like anything was a conflict with something that I'm doing for clients, they would disallow it, meaning they would force me out of the position. Okay, so I run that risk. I have to be careful about the options that I buy and make sure that they don't have any potential conflict with the things I'm doing for my clients. As a general rule, folks that work in my business, their firms frown upon options. Okay, and why is that? Because between the leverage, which increases the risk substantially, when you invest in options because of leverage, you increase your risk substantially. It's like the difference between buying a home with cash or buying a home and using a bank to buy it. Okay, so if I buy a $200,000 home and I pay cash for it, if the market goes down and my value of my house goes down to $150,000, I still live in my home. I'm just fine, right? Nobody's going to be able to take my home away from me. If I buy a home for $200,000 and borrow $200,000 and my home value goes down to $150,000, there's a chance that the bank might take it away from me, right? So it increases the risk to have debt. Same thing is true with options. When you introduce margin, which is using debt when it comes to investing, you introduce a new level or a higher level of risk. And so most firms that you might work for as a CFP or as any kind of advisor are not keen on allowing advisors to take a lot of risk, right, with their own funds. If they go broke, they might be more driven to do the wrong things for their clients just to make a quick buck. Okay, so firms are always looking at that and evaluating that. And as a general rule, Brad, it's kind of frowned upon. Some firms say no options. Some firms just say we reserve the right to disallow whatever you do. And so if we see any potential conflict of interest, we'll just disallow it and force you to get out of it. Okay. Did that kind of answer your question? I mean, it's not, yeah, even for personal use, exactly, because they're watching it. It's not just the trades that I put on for my clients that they're watching. They actually can see, by law, they can see everything I do personally. So I have to be very careful about the types of things I'm trading in my own personal accounts because they can see them. And if they don't like them, they can disallow them or force me to sell them. That's just one of the restrictions associated with being in my business as a regulated investment advisor. People usually who are helping people with options are not registered investment advisors. All they're doing is trying to sell literature or books or programs, software programs. And to do those things, you don't need to be a registered investment advisor. You don't have to be a regulated registered investment advisor to just sell information, right? If you're actually putting people in an account where you manage their money for them using options, then you absolutely have to be regulated, and it's a highly, highly regulated business when you start doing that. So in my personal practice, do I do a lot with options for my clients? The answer is no. And a lot of it has to do with the amount of risk associated with using options, right? Most of my clients are not willing or able to take the amount of risk that it takes to be an option investor. All right, you got all kinds of different options. You got puts, calls, rights, warrants. Puts and calls are the most straightforward types of options. Puts are something that you would buy if you were trying to bet that the particular underlying product that you're buying a put on is going to go down, because you would benefit if it goes down by buying a put. A call is something that you use leverage and benefit by if the market goes up or if the investment product goes up that you're investing in. Rights and warrants are just the ability at some point in the future to have that you can buy that particular investment. So if I have a right to buy GE stock at $30 a share, and it expires in 3 years, anytime over the next 3 years, I could buy GE stock at $30 a share. Now, if the stock stays under $30, how much is that right really worth? It's not worth anything. But if GE stock goes up to 35 and I have a right that tells me that I have the right to buy it at 30, then I've got something that's very valuable, right? Because I've got $5 of built-in value if I were to exercise those rights or warrants, same idea. Ability to buy in the future. But puts and calls are what you're really they're kind of the basis for options investing that you would hear about. And basically the idea is if I buy a call on GE stock or a put on GE stock, if I buy a put, it's because I believe that the stock is going to go down and I'd benefit from it. If I buy a call, I believe that the stock is going to go up and I'd benefit by that. The worst thing that can happen with a call is that if you buy a call, is that you can lose all your money that you invested. The worst thing that can happen in a put is that, again, you could lose all your money. You could lose everything you put into it. Now, there are other types of options that you could lose more than what you put in. For example, there are always buyers and sellers of each one of these options, so there's always got to be somebody on both sides of the coin or an option won't take place. Okay, you have to have a buyer and seller. And if I'm the seller of a call, theoretically, I could lose more than the money I make on it. So I might potentially make $2 or $3 off selling a small call contract, but I could lose $100 if that particular product went way up, right? Because if I'm selling a call or buying a put, both of those mean that I'm bearish. I'm thinking that it's going to go down. If I buy a call or sell a put, that means I think it's going to go up. And if I'm wrong, then there's a potential on some of those to lose more than even the money that I put in or potentially gain from it. So that's where you get into this risk issue, where a normal investment product, if I buy a $30 stock, right, and the stock goes to zero, then I just lost my $30. Well, in some of the options, I put $30 into an option, I could lose $500, which sounds crazy, but that's just how options work. You can lose more than you even potentially could gain on some of the options that you invest in. So why would anybody do it? Because you can use other people's money. Again, you can use leverage to be able to enhance the potential for returns. But that same potential for returns can be potential for loss. So you just have to be careful. Okay? The average investor that I work with, no matter how sophisticated they are, does not use options. Okay? Options came into being because they were used by companies and farmers to hedge different things. So they were primarily came into being to be a hedge product. Now, investors sometimes use them as speculation products, and they can get themselves in some big trouble by speculating with them. If you're using it as a pure hedge, to hedge something, options can be a great tool. They can really work well. So puts and calls commonly are traded on stocks, indexes, ETFs, currencies, debt. They can do commodities. You can buy hedges and buy options on all kinds of different products and different underlying securities. So if you said today, hey, I think gold's going to go way down, or I think silver's going to go way down, or I think oil's going to go way down, these are ways to benefit from that idea. And if you're right, you'll make some money. If you're wrong, you stand to lose some money, right? But investing in the market's not always about, okay, I've got to have it go up or else I'll if it goes down, I'll lose money. You can actually take the opposite side of things and say, okay, if this goes down and I'm right, then I'm going to make some money. There's a very outspoken hedge fund investor named Bill Ackman. And Bill Ackman a few years ago bought short Herbalife. Herbalife's that big supplements company, big multi-level marketing company. Some of you might be familiar with Herbalife. And Bill Ackman, his whole goal with investing in Herbalife was not to see it go up, but actually he was hoping that it would go down because he would benefit and get gains by it going down. Okay, hasn't worked out too well for him over the past few years, but he's still waiting. He really believes that at some point that stock is going to go way down, and if it does, he'll make a lot of money. Okay. All right, so that's just an example of an investor out there that's in the news. You could, in fact, there's a special on Netflix if you are interested on Bill Ackman and Herbalife and his fight with Herbalife basically over the past couple years, trying to bring them down basically so that his investment would go up. All right, we've only got a few minutes left, so we do need to skip over to this week's test. I apologize, we have to cut both the slide presentations a bit short tonight. But let's go through these 10 questions and make sure you know the topics that are going to be on the test. The first question is a true-false question asking about what type of instruments are going to be in a conservative asset allocation. So if you've got a really conservative asset allocation, what types of instruments are going to be inside? Are they going to be stocks? Are they going to be international stocks? Are they going to be short-term securities? Are they going to be bonds? Are they going to be some kind of mixture of those? But what's going to be more weighted or more focused on in a conservative asset allocation? We went over some slides tonight that I showed you 3 different examples: conservative, moderate, and aggressive asset allocation, and it actually showed those 4 categories. And we talked about what conservative asset allocations are more focused on versus aggressive ones. But if you need to look back at it, just make sure you know what conservative asset allocations have the most of before you get to the test. Number 2 on the test, make sure you know the steps of constructing a portfolio. So we talked about when we were building our own portfolio, in the building your own portfolio chapter 13, we talked about 4 or 5 basic steps on what you need to do and understand before you start to pick different investments. And just make sure you understand the order of that, right? We don't just go out and buy investments first. We actually go through a system of getting to know ourselves and making sure we understand exactly what we should be doing before we go out and buy. Just like my example of doing the research, knowing what you want before you go to a car dealership. The same is true for investments. So if you know that, you'll get number 2 right on the test. Number 3 on the test, ask a question about utility stocks. See what the book has to say in chapter 13 about utility stocks, and you'll get number 3 right on the test. Number 4 on the test. Number 4 on the test is a real basic question about asset allocation. When you do asset allocations, and again, you could go back to that slide where it showed conservative, moderate, and aggressive, 3 different portfolios, and you could look at the percentages that go into different things. In none of them, none of those 3 different asset allocations have exactly the same percentage going into each category, right? Because that's not how you do asset allocation. In asset allocation, if it's a true asset allocation, you'll have different percentages going different places because it depends on how much risk you're taking and what types of instruments the focus will be on. So if you understand that basic concept of asset allocation, you'll get number 4 right on the test. Number 5 on the test, how do we determine how to build an investment portfolio? How do we build it based on the stock market, what's hot in the stock market? Do we base it on what an investment advisor makes the most money off of? No, of course not, right? So what is it? What are we focused on when we, before we actually pick investments? What determines what we're going to do as far as those investments are concerned? If you understand that, you'll get number 5 right on the test. And we talked about that. We talked about suitability and objectives. It was one of the first slides tonight. If you know what we're trying to figure out there, then you'll get that answer right. All right, number 6 on the test. Just trying to go through. Number 6 on the test starts the section on options. So it tells you a little bit, it's going to ask you some questions about options. The number 6 asks you, what does somebody actually own when they own a stock option? Okay, what do they own? So we're not talking about specifically a call or a put. We're just talking about generally speaking. Remember we talked about how they're derivatives of an underlying product, but basically it either gives you the obligation to buy or sell that product at some point, okay, at a certain price. That's what an option is. So you have the right to buy or sell a certain amount of shares. That's what an option is when you buy a call or a put. Excuse me. All right, so number 7 on the test, just know what the definition of a right is. So we talked about puts, calls, rights, and warrants. Make sure you understand what the basic definition of all 4 of those, but specifically rights will be defined on number 7. You'll get that one right if you know what it is. Number 8 on the test, the maker of a put or a call is who? Who is the maker of a put or a call? So there are 3 different words that we use synonymously when it comes to puts and calls. Seller, writer, and maker. Okay? Seller, writer, and maker. All those mean the same thing. Okay? It's the person on the other side that someone is buying from. So if I buy a call, I've got to have somebody on the other side be willing to sell me that call, right? And they're a seller, writer, or maker of that call. That's the person who I get it from. Those all mean the same thing. If you understand that, you'll get number 8 right on the test. Number 9 on the test, again, who is the writer of a call or an option? Who is the writer of a call or an option? You'll get that from chapter 14. We talked about it a little bit tonight. And what is the first listed exchange for stock options in the United States? So basically, options history 101 for number 10 on the test. What exchange was the first one to trade options here in the United States? Should be in chapter 14 when it gives you a little bit of background and history on options trading. There's an exchange. So you've got like the New York Stock Exchange that does stocks and has been around for a long time. Which exchange in the United States was the one to first do options trading? And you'll get number 10 right on the test. Anybody need a repeat on any of the questions or kind of a clarification on any of that without giving the answer or giving more information on it? Well, good. We got to wrap up. Again, I hope today was a good Eclipse Monday. Hope you had a good first 2 weeks of the class. Let me know if you have any questions or concerns. Good luck this week with the assessment assignment. And let me know if you get stuck with anything, but I'll look forward to seeing your work come in. And just best to all of you. Thanks for participating tonight. Deja, when is this posted? When will I post the session? Is that what you mean? I'll have it up tonight. So you'll be able to review the video later tonight if you want. Thanks, Brad. Have a good one. Good night, everybody.